If you observe carefully what happened to silver throughout 2025, you'll see something that should make any experienced observer of financial markets pause and reflect deeply. Silver didn't just have a good year. It experienced one of the most dramatic rallies in modern financial history. Rising from approximately $24 per ounce at the beginning of 2025 to peaks above $86 before settling around $72 at year-end, a gain of over 200%. Most people who noticed this rally at all dismissed it as speculation, another bubble in commodities, or perhaps manipulation by large traders. But when you understand how silver has functioned throughout monetary history, when you analyze the specific conditions that drive silver demand, you realize this wasn't speculation. It was the market pricing in scenarios that most Americans can't imagine and don't want to consider. Dalio has often observed that markets signal major transitions long before they become obvious to the general public. According to institutional research on precious metals markets, silver's behavior during 2025 fits historical patterns that have preceded every major monetary system transition over the past century. This isn't about predicting the future or encouraging speculation in precious metals. This is about understanding what silver's price action reveals about underlying economic conditions and what those conditions mean for anyone trying to protect their wealth in an increasingly uncertain monetary environment. The historical context of silver as a monetary signal. To understand what silver is signaling today, you need to understand its unique role in monetary history. Unlike gold, which has primarily served as a store of value for central banks and governments, silver has functioned as the people's money throughout most of human history. According to monetary historians, silver was the primary medium of exchange for ordinary commerce in most societies until the early 20th century. When people lost confidence in government-issued paper money, they typically turned to silver before gold because silver was more accessible and practical for everyday transactions. This historical relationship means that silver prices often signal changes in popular confidence in monetary systems before those changes become apparent in other markets. When silver begins rising rapidly, it typically indicates that increasing numbers of people are questioning the stability of their monetary system. Dalio's research on monetary cycles shows that precious metals, particularly silver, tend to anticipate monetary policy changes by 6 to 18 months. The silver rally that began in late 2024 and accelerated through 2025 started well before most people recognized the monetary pressures that became obvious by the end of 2025. The supply and demand fundamentals that amplify the signal. One reason silver's price movements are particularly significant as monetary signals is the unique structure of silver supply and demand. According to industry data from precious metals research firms, silver markets are much smaller and less liquid than gold markets, which means that changes in demand create much larger price movements. The total annual silver market is approximately $25 to $30 billion globally, compared to over $200 billion for gold. This means that even relatively small shifts in institutional or individual demand can create dramatic price movements in silver. But more importantly, for understanding silver as a monetary signal, silver demand comes from three distinct sources that respond to different economic pressures: industrial demand, investment demand, and monetary demand. Industrial demand for silver comes from its use in electronics, solar panels, medical applications, and other technologies. This demand is relatively stable and predictable, growing gradually with technological advancement and economic growth. Investment demand comes from people buying silver as a portfolio diversification tool, or as a hedge against inflation. This demand can be volatile, but typically follows recognizable patterns related to stock market performance and interest rate environments. Monetary demand is different. This is demand that emerges when people begin questioning the stability of their monetary system and start acquiring silver as an alternative store of value. Historical analysis shows that monetary demand can overwhelm both industrial and investment demand during periods of monetary uncertainty. The 2025 rally. Beyond normal investment demand. According to data from precious metals dealers and ETF flows, the silver rally of 2025 showed characteristics that suggest it was driven primarily by monetary demand rather than normal investment or industrial demand. Traditional investment demand for silver typically correlates with stock market weakness, dollar weakness, or rising inflation expectations. But silver's 2025 performance occurred during a period when stocks were relatively stable. The dollar maintained reasonable strength against other major currencies, and official inflation statistics remained moderate. This suggests that silver's rally was anticipating monetary conditions that hadn't yet become obvious in traditional economic indicators. Professional precious metals analysts noted that the buying patterns showed characteristics typical of monetary panic buying rather than normal portfolio allocation. Ray Dalio has observed that when precious metals begin rising despite stable conditions in traditional markets, it often indicates that sophisticated investors are positioning for monetary scenarios that haven't yet become mainstream concerns. The institutional response. What big money was actually doing? One of the most significant aspects of silver's 2025 rally was the institutional response. According to regulatory filings and industry reports, several categories of institutional investors significantly increased their silver exposure during 2025. Central banks, which traditionally focus on gold reserves, began adding silver to their reserve portfolios for the first time in decades. Sovereign wealth funds increased their precious metals allocations, with silver receiving disproportionate attention relative to its historical role in institutional portfolios. Even more significantly, family offices and high-net-worth individuals began accumulating physical silver in quantities that stressed the physical delivery markets. Reports from precious metals dealers indicated waiting periods for large silver purchases that hadn't been seen since the 1970s. This institutional buying pattern is particularly significant because institutional investors typically don't speculate in commodities. When institutions begin accumulating large positions in silver, it usually indicates they're preparing for scenarios they consider probable rather than just possible. The technology factor. Silver in the digital economy. One factor that makes silver's current monetary signal different from historical patterns is its increasing importance in technology applications that are critical for the modern economy. According to industrial research, silver is essential for solar panel production, electric vehicle manufacturing, 5G telecommunications infrastructure, and numerous other technologies that are central to current economic development plans. This creates what economists call a strategic commodity dynamic. Silver isn't just a monetary metal anymore, it's also a critical industrial input for technologies that governments consider essential for national competitiveness and security. When the U.S. government officially designated silver as a critical mineral in 2025, it acknowledged this dual role. But it also created a situation where monetary demand for silver competes directly with strategic industrial demand. Ray Dalio's analysis of resource cycles suggests that when a commodity becomes both monetarily and strategically important, simultaneously, price volatility increases dramatically because different types of demand compete for the same limited supply. The supply constraint reality. According to mining industry data, silver production has been essentially flat for over a decade despite rising prices and increasing demand from multiple sources. New silver mine development takes 7 to 10 years from discovery to production. And most new silver production comes as a byproduct of other metals mining. This supply constraint means that increasing demand, whether from industrial, investment, or monetary sources, translates directly into higher prices rather than higher production. The silver market cannot respond to demand increases the way most commodity markets can. Professional commodities analysts note that silver's supply constraints make it particularly sensitive to monetary demand shocks. When people begin acquiring silver for monetary reasons, the price impact is immediate and dramatic because new supply cannot be brought online quickly. Historical analysis shows that during previous periods of monetary uncertainty, Silver supply constraints created price spirals where higher prices attracted more monetary demand, which created even higher prices in a self-reinforcing cycle. The international dimension: what other countries are doing. One aspect of silver's 2025 signal that most Americans missed was the international dimension. According to trade data, several major economies began accumulating silver reserves and implementing policies that favored silver acquisition by their citizens. China, which had been a major silver exporter, began restricting silver exports and encouraging domestic silver acquisition. Russia increased its silver reserves alongside its well-publicized gold accumulation. Several Middle Eastern countries began diversifying their dollar reserves partly into precious metals, including significant silver positions. This international pattern suggests that silver's rise wasn't just reflecting American monetary concerns, it was reflecting global concerns about the stability of the dollar-based international monetary system. Ray Dalio's global macro perspective emphasizes that when multiple countries begin accumulating the same alternative assets simultaneously, it typically indicates coordinated preparation for changes in the international monetary system. The leverage factor: how derivatives amplify the signal. One technical factor that makes silver's price signals particularly important is the role of derivatives in silver markets. According to market data, the silver futures and options markets are much larger than the physical silver market, creating leverage that amplifies price movements. When monetary demand for physical silver increases, it creates pressure in the derivatives markets that can result in price movements much larger than the underlying supply and demand fundamentals would suggest. This leverage effect means that silver prices can signal monetary concerns even before those concerns become widespread. Professional precious metals traders note that silver's derivative structure makes it function like a canary in the coal mine for monetary system stress. Small increases in monetary demand get amplified through the derivatives markets into large price signals. This amplification effect is why institutional investors pay close attention to silver price action, even if they're not directly involved in precious metals markets. Silver's leverage makes it an early warning system for monetary conditions that might affect all asset classes. The correlation breakdown: silver versus traditional assets during 2025. Silver exhibited what market analysts call correlation breakdown relative to traditional asset classes. Normally, silver prices correlate somewhat with stock prices, bond prices, and currency movements. But during 2025, these correlations largely disappeared. Silver rose while stocks were flat. Silver rose while bonds were stable. Silver rose while the dollar maintained relative strength. This correlation breakdown is historically significant because it indicates that silver was responding to different drivers than traditional financial assets. According to institutional market research, correlation breakdown in precious metals typically occurs when monetary factors begin overwhelming investment factors in driving demand. This is considered one of the most reliable signals that monetary conditions are changing in ways that traditional asset classes have not yet recognized. Ray Dalio has observed that correlation breakdown in commodities markets often precedes broader market recognition of changing economic conditions by 6 to 12 months. The physical premium signal: one thing people missed during silver's 2025 rally was the gap between physical silver prices and paper silver prices. Throughout the year, people buying actual physical silver paid increasingly higher premiums over the spot price quoted in futures markets. According to precious metals dealers, these physical premiums reached levels not seen since the 1970s. This indicates that demand for actual silver ownership was far exceeding demand for silver exposure through financial instruments. The physical premium signal is particularly important because it indicates that people weren't just seeking silver exposure for portfolio diversification. They were seeking actual silver ownership for monetary protection purposes. Historical analysis shows that rising physical premiums typically precede broader recognition of monetary system stress. when people are willing to pay significant premiums to own physical precious metals rather than paper claims to precious metals. It indicates preparation for scenarios where the financial system's functioning might become unreliable. The generational shift in precious metals perception according to demographic analysis of precious metals buyers. One significant change during 2025 was increased silver acquisition by younger investors who had previously shown little interest in precious metals. Traditionally, precious metals buyers have been older investors who lived through previous periods of monetary uncertainty. But 2025 saw significant increases in silver buying by investors under 40, particularly those involved in technology industries who understand both silver's industrial importance and monetary history. This generational shift is significant because it suggests that concerns about monetary system stability are spreading beyond traditional precious metals. Investors to people who generally favor technology-based solutions and modern financial instruments. Professional market researchers note that when precious metals buying spreads across generational lines, it typically indicates that monetary concerns are becoming mainstream rather than remaining confined to traditional. Gold bugs and inflation hawks. The central bank response. What they're not saying. While central banks publicly maintained that inflation was under control and monetary conditions were stable, their actions during 2025 suggested a different assessment of underlying conditions. According to central bank data, gold purchases by central banks reached record levels during 2025, and several central banks began adding silver to their reserves for the first time in decades. These actions occurred despite public statements that precious metals were unnecessary for modern monetary systems. The disconnect between public statements and actual central bank behavior is significant because central banks typically don't accumulate assets they consider unnecessary. When central banks begin acquiring precious metals while publicly downplaying their importance, suggests preparation for scenarios they're not discussing publicly. Dalio has observed that central bank actions are typically more revealing than central bank communications when it comes to understanding their actual assessment of monetary risks. The technology disruption angle. One factor that makes silver's current monetary signal particularly complex is the intersection between traditional monetary concerns and modern technology disruption. Silver is essential for many technologies that could potentially reshape monetary systems from blockchain infrastructure to renewable energy systems. According to technology industry analysis, the same technological developments that could disrupt traditional banking and monetary systems also require significant amounts of silver for their implementation. This creates what economists call a convergence trade, where traditional monetary hedging and technology investment point toward the same asset. Professional technology investors note that silver represents one of the few ways to gain exposure to both monetary system transition and technology infrastructure development simultaneously. The political economy implications. Silver's 2025 rally occurred during a period of increasing political polarization and declining confidence in government institutions. According to political economy research, precious metals acquisition often increases during periods when citizens lose confidence in their government's fiscal and monetary management. The timing of silver's rally alongside declining trust in government institutions suggests that monetary demand for silver was driven partly by political concerns rather than just economic concerns. This political dimension makes the signal more complex, but potentially more significant for long-term monetary system stability. Historical analysis shows that when precious metals acquisition becomes connected to political concerns, it typically indicates deeper systemic problems that purely economic policy responses cannot address effectively. What the signal means for individual wealth protection. Understanding what silver is signaling has practical implications for individual wealth protection strategies. If silver's 2025 performance was driven by monetary system concerns rather than normal investment demand, it suggests that traditional wealth protection strategies may be inadequate for current conditions. According to institutional wealth management research, periods when precious metals signals indicate monetary system stress. typically require different asset allocation approaches than periods when precious metals move for normal investment reasons. This doesn't necessarily mean everyone should buy silver, but it means that wealth protection strategies should account for scenarios where traditional monetary relationships might not function as expected. Ray Dalio's principles-based approach emphasizes that when markets are signaling scenarios outside normal parameters, portfolio construction should prepare for a wider range of possible outcomes rather than assuming historical patterns will continue. The timing question: early warning or false alarm? One question that emerges from analyzing silver's 2025 signal is whether it represents an early warning of actual monetary system problems or a false alarm driven by temporary factors. According to historical analysis of precious metal signals, silver has provided an accurate early warning of monetary system stress in most historical cases, but with significant timing variability. Sometimes the problems silver anticipates emerge within months. Sometimes they take years to become obvious. The challenge for individual investors is that acting on silver's signal too early can result in opportunity costs. If traditional assets continue performing well while ignoring the signal entirely, can result in severe losses if the signal proves accurate. Professional risk management approaches typically address this timing uncertainty by gradually adjusting portfolio allocations rather than making dramatic changes based on any single indicator, even one as historically reliable as silver's monetary signals. The International Monetary System context silver's 2025 signal must be understood in the context of broader changes in the international monetary system. According to international monetary research, the dollar-based system established after World War II is facing pressures that haven't existed since its creation. Rising national debt levels in major economies, increasing geopolitical tensions, and the development of alternative payment systems all create conditions where traditional monetary arrangements might need to evolve significantly. Silver's role as both a monetary asset and a strategic commodity positions it uniquely to benefit from transitions in international monetary arrangements. This dual role may explain why silver's 2025 signal was so pronounced compared to other precious metals. Silver isn't just signaling concerns about inflation or economic growth, signaling concerns about the fundamental stability of monetary arrangements that most people take for granted. These are the types of concerns that create the most significant wealth transfer events in economic history. Most people who noticed silver's 2025 performance dismissed it as speculation or market manipulation. But when you understand silver's historical role as a monetary signal, when you analyze the specific characteristics of the 2025 rally, and when you place it in the context of current monetary system pressures, a different picture emerges. Silver was signaling that sophisticated investors, institutions, and even governments are preparing for monetary scenarios that go far beyond normal economic cycles. Whether these scenarios materialize quickly or take years to unfold, the signal itself is historically significant. Understanding what silver is signaling doesn't require becoming a precious metals speculator. It requires recognizing that current monetary conditions may be less stable than they appear, and that wealth protection strategies should account for a wider range of possible outcomes than traditional financial planning typically considers. The signal is there for those who know how to read it. The question is whether you'll recognize its significance before the conditions it's anticipating become obvious to everyone else. This content represents an educational analysis of precious metals, market signals, and monetary system dynamics. It should not be considered personalized investment advice. All financial decisions should be made in consultation with qualified professional advisors who can assess individual circumstances and objectives.